know what, let's talk about the global cues a bit before we go forward. The big talking point globally has been the way oil has been collapsing, and now oil is down 50% in the last 18 months, and that has been having a contagion impact on some of the banks that have exposure to energy companies globally. Xavier Dennis, who is a global strategist at Societe Generale, joins us on the phone line to discuss all of this. Xavier, hi, good morning, and thanks for joining us. Is that a worry for you as well, that now there could be a contagion impact of the fall in crude that could, have a ripple effect on other sectors like banks, etc.?
I'm not so worried about the exposure of banks to the energy sector. I think that most of the liquidity and financing provision has been made on a short-term basis, and I think that probably what the most exposed are investors, in fact, on the high-yield universe. So I think that so far things can be mitigated from the banking perspective. I'm a little bit more worried about the spillover impact from the U.S. high-yield sector or energy sector to the rest of the U.S. market, and in turn to other high-yield markets as well.
Okay, actually that's what I was coming to, Xavier. Good morning and thank you for joining us. Over the weekend, we now know that U.S. exports, crude exports, are now possible. The 40-year ban is off. Is that a well-documented news and therefore no fresh reverses for crude? Or will there be fresh reverses and therefore fresh risk-off for equities?
Yes, I think that it's an additional bearish factor regarding oil price, and I think that for the coming few weeks and months, I think that oil price may continue to trend down. For the energy stocks, I would be probably a little bit less pessimistic. I think that lots of energy stocks, oil producers are really delivering a very compelling dividend yields. And I think that it may be too early to do that, but I think at some point in time during the first part of 2016, there will be probably some very good entry points to rebuild position on the energy sector.
Okay, so how does one really approach equities now, Xavier? I mean, it's the year 2015 has been extremely lackluster for global equities. What's your expectation for 2016?
2016, I think that it will be a year of modest expected return. Clearly, this will be the case again for the equities. We are clearly very much worried about the bond market. Regarding stocks, I would say we still prefer developed market stocks. I think that we do anticipate more upside on the Eurozone and also on Japan equity markets. We tend to be a bit more cautious regarding the U.S. market. I think the combination of the Fed hike and also stretch valuation are clearly big headwinds for the U.S. market. But I think that dispersion also it will be one of the big themes for 2016. I think that also, as already mentioned in the previous discussion, I think that mid-caps are probably likely to post a better performance. I think that in a world where consumption and service sector are going to lead the growth, I think it's probably more interest to look into mid caps than to look at large caps.
Okay, that's what our in-house expert has been telling us. But just a last quick question. What are you doing about India, equities and bonds?
I think that India remains probably one of the most compelling play regarding the emerging market space. I think regarding equities, we know that valuation are a bit expensive, but we are it's still an overweight in our allocation within the emerging market space. And I think that also bond markets are probably likely to post very good performance. I think that receding inflation, the possibility of additional rate cuts, and also the limited exposure of the bond market to foreign investors, the limited foreign bond holdings, are clearly positive for the bond market. So in both cases, we keep an overweight.
Right, we leave it at that, Xavier. Thanks so much for joining us. So 2016 will be a year of modest equity returns. That's the word coming in from Societe Generale. And they also believe that developed markets will continue to outperform emerging markets in 2016.